This week on Wealth Track, Morgan Stanley's asset allocation king David Darst teams up with Mutual Global Discovery Fund's Peter Longerman to dig for hidden treasures in world markets. Where are they finding buried bargains? Darst and Langerman are next on Consuelo Mack Wealth Track.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Luma Sales, investors seeking exceptional opportunities globally. Wintergreen, your home for global value. And Rosalind P. Walter. Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. This has been a great time to be a U.S. investor. Over the last couple of years, American stock markets have outperformed the gains in other developed markets, including Europe, and have trounced the losses experienced in many emerging markets. Having a home bias has paid off, but will it continue to do so? Well, if history is any guide, the answer is no. According to a study of the performance of 12 different global asset classes over the last decade by wealth management firm Gerstein Fisher, one year's winners are rarely next year's victors. Last year's winning category, Global Real Estate Investment Trust, has dropped out of the top 3 performers this year. Gold, the number 1 asset class in 2010 and 2011, is near the bottom of the list so far this year. And the move into emerging markets, which was so rewarding in 7 out of the last 10 years, is now lagging badly. Gerstein Fisher's conclusion: it is nearly impossible to pick winning asset classes in advance, and in fact, broad global diversification is the best long-term strategy. It's beaten U.S.-focused investing pretty consistently over the last 10 and 15-year periods. We will have a copy of their research report on global investing on our website, wealthtrack.com. Global investment trends and strategies are our focus on this week's Wealth Track with 2 investment pros. Peter Longerman is the chairman, president, and CEO of Franklin Mutual Advisors, where he oversees the value-oriented mutual series funds. He is co-portfolio manager of several of them, including Mutual Global Discovery and Mutual Shares. Financial thought leader David Darst is a Wealth Track regular. He is chief investment strategist of Morgan Stanley Wealth Management with responsibility for asset allocation and investment strategy. He is also the author of 7 books, including a wonderful primer on the art and science of asset allocation titled The Little Book That Saves Your Assets. I began the interview by asking Longerman, as a deep value investor, about his view of the U.S. stock market given its strong multi-year performance.
Things aren't as cheap as they were. On the other hand, my view is they're not so out of control in terms of valuations and what's really happening at the company level that we feel that the market is overvalued. There are always pockets, in our view, that people are not looking at or worried about, and that's what we tend to focus on. And at the same time, there's some areas that have done very well, and where we had exposure, we've trimmed, and where we're avoiding. So there are things to do, and that's good for us as bottoms-up value investors.
Right. So David, at Morgan Stanley, your view of the U.S. stock market, given the run-up that we've had in the last couple of years?
Well, it looks on a short-term basis to perhaps be a bit overbought right now, Consuelo. Volatility is very low, margin debt is very high, trading volume has been very low of late. That having been said, the 4 engines of this U.S. market and economic aircraft are all firing very, very flawlessly. Monetary stimulus is still in place. Number 2, the housing market, new home sales, existing home sales, pending home sales, builders' confidence. Number 3, the consumer. Retail sales, consumer confidence. These numbers, consumer borrowing. People have been willing to take on some debt to purchase things. And finally, the production side, Philly Fed, the Empire State Manufacturing, the Chicago Purchasing Managers Index. So a lot of these you won't believe this, but the 55 reading that just came out a couple of weeks ago on the ISM manufacturing, anything above 50 means expansion.
So, looking at where you could invest in the globe, about half of Global Discovery Fund or the Mutual Series funds are in the U.S.
Yes.
So you're still finding value in the U.S. What kinds of situations are you looking at that are particular, that are kind of emblematic of what you're doing at Mutual Series?
Sure. Some of the things that we've looked at recently are in the underperforming areas, such as energy, for example. Energy, by and large, has been an underperformer. There are lots of reasons. Part of them is macro. Part of them is just the nature of those businesses. They're very capital intensive, by and large, and they haven't really participated in this general market recovery. So there's some specific companies. Again, it's not let's find an industry and invest in a bunch of different companies. It's much more company specific. But for example, there's some E&P companies, exploration and production companies that have kind of been left behind. There's been some names in the news where some large shareholders, activist shareholders, have taken the opportunity to say, wait a second, these are underperforming companies that have lots of value, good asset value, but they haven't really demonstrated that in terms of their stock price.
So Apache, for
instance. So a name like an
one
Apache,
of
where we're active, we've owned it for a while, we engage with management. They've actually taken some steps of late to announce sales of assets, rationalization of their business, doing things that we think are moving in the right direction, albeit they have a ways to go, but to highlight the values. It's a stock that trades in the 80s that we think is worth well north of 100, and the asset value really is there to demonstrate it, but they've got to show the world that they can actually get there. Some of the med tech names is another area. Now, those names have done, by and large, pretty well, but a name like a Medtronic, which we still think trades too cheaply. People still have lots of issues with the nature of the business and product liability issues. There's a medical tax issue, but you cut through all that. They've got a CEO who really is focused on delivering value to shareholders, returning cash to shareholders, being more thoughtful about acquisitions. So that's the kind of name that we look at, that we still think there's lots of opportunity there for us.
So patience, how patient are you as a deep value investor?
I think for value investors, there's a balance. I think most value investors like ourselves want to make sure that you're right on the values, right? If you're right on the values and you're buying something at 60% of intrinsic value, you're willing to wait.
It's so interesting because what his view as a professional versus what usually the individual investor's view is very different. Individual investors don't tend to be that patient, right? And so I'm looking now at we've had changes in different asset values, and we're seeing some very marked fund flows, David. For instance, the last couple of months, there have been wholesale selling of bond funds, and individual investors have been moving into U.S. stock funds.
Many of your viewers, many of our generation, the baby boomers, there are 76 million of us born from 1964 to 1946 to 64. We basically want our portfolios to have a little bit more stability and give a little bit more predictability of income. So that was the driver into the bonds. So I find it good. This has only been, this is early innings for people, for this massive great rotation you've talked about on your show. We have a lot of cash, which is yielding you nothing. However, it's yielding you 22% if you didn't buy Brazil. It's down 22% this year. So you basically have that as dry powder. The market has run up a lot. Should it pull back in the U.S., in Japan, if it even gets further cheap in Europe that Peter's been talking about, we would basically be adding to U.S. stocks, to Japanese stocks, and then begin to nibble at European stocks.
So this is emerging incremental you're
That's
talking
right.
about.
So we think it's early innings, this great rotation out of bonds, but we would say to all your viewers, be very careful. If bond interest rates rise by 1.5% from this level, right now a 2-year bond yields only 30 basis points, 0.30. A 10-year is 2.
These are the treasuries.
10-year treasury, 2.58, and a 30-year treasury is 3.58, right about 100 basis points more. If interest rates go up by 1.5%, 150 basis points, Consuelo, a 2-year bond loses 1%. Okay? A 10-year bond, in principal value, a 10-year bond loses 11%, and a 30-year bond loses 25%. So we say to all your viewers, be very careful, analyze the maturity structure of your portfolio, and be looking at short duration bonds and or floating rate notes. whose capital doesn't change because the coupon changes if interest rates do rise. We don't see rates spiking upward, but we think they've gone down. Your viewers know they've gone down for 32 years. Since 1981, here we are in 2013. So you've had a long, long bull market in bonds. So to me, it's a wonderful thing that individuals are starting to shift from bonds into stocks. There was a period earlier this year when they were moving from bonds into cash.
Right.
And so a year ago, we had 30% in stocks. Today, we're 42% in stocks for a moderate high net worth investor. A year ago, we were 42% in bonds. Today, we're 30% in bonds. Most of the reduction has come in the mid and long maturity corporate and government bonds.
The problem is no one wants to be the last guy out of their bond fund or whatever, so that's why it's such a temptation to make some pretty radical moves. You know, you just talked about Europe, so Morgan Stanley, you know, starting to think about investing in Europe. You are there, Peter, in the mutual series fund. So tell us, and you're there in a very contrarian way. So tell us what your European strategy has been.
Yeah, it's interesting that. I think our initial view was that Europe would not completely implode. It semi-imploded, but didn't completely go off the rails, which was, to some extent, a contrarian view. A lot of people talking about the breakup of the euro, et cetera. It got bad, but it didn't get that bad. So we were there. But actually, what we've been focusing on more recently, that I think still is a bit unusual, is companies that are Eurocentric, that are not only headquartered and domiciled in Europe, but actually doing most of their business in Europe. There's certainly lots of companies that are headquartered in, whether it's the UK or Switzerland, but their business there is minimal.
No, it's 40% emerging market.
Right.
I mean,
so
that's
they're Europe in name, but
right.
and that was a theme. You know, they kind of got tarnished with everybody else that was in Europe. But we've, in a sense, gone beyond that because there's some companies that actually do most of their business, or a lot of their business in Europe, and we're seeing some signs, even from some of the major brokerage houses, saying, "Oh, you know what? Europe actually is showing a little bit of life here." And you know, it was recession, almost catastrophe. Now it's not great growth. Nobody's talking about Europe being China. On the other hand, if they're just stabilized, that's a big victory. And so there are these companies. Metro is an example of a company that's basically a European-centric company headquartered in Germany, but has lots of operations in Europe. But it's a consumer-based business.
So what
it's
is
going
it?
through a
Consumer
restructuring.
electronics?
It's in electronics. It's in hypermarkets. It's in cash and carry. A lot of those types of businesses. It's also going through a restructuring. We like that. It's got a new CEO. So they're selling assets. They're restating their financials to make it more understandable, being a bit more shareholder-friendly. But it's also in the context of an overall situation that is stabilizing and getting a little bit better. So I think, again, we're not in the business of making these kinds of predictions about big picture, macro trends, but we are seeing from the ground up, talking to CEOs, talking to companies, that by and large things are okay. Not great, and there could be another bump in the road, but they're not the disaster that most people were anticipating was going to happen.
And your European stocks have a nice yield of about 3.8%, Consuelo, versus 2% in the United States. And they're at a 40-year low. Peter knows this, a 40-year low relative to the United States in terms of the price earnings relative multiple. In Europe, they sell for 12 to 13 times earnings. In the U.S., it's 15 to 16. That's a 40-year cheapness. All you need is a little catalyst, and we think that catalyst might be September 22nd, which is a Sunday, the big elections in Germany. Chancellor Merkel is likely to be reelected for a third term.
So is that the positive scenario?
We think that
because
could be it, because she, we believe, will open up the purse strings, bilaterally, not through the IMF, the European Commission, nor the European Central Bank. She would open up the purse strings to companies, small-sized companies in Spain, in Portugal, in Ireland, and we think that is a big opening of the purse strings selectively by Germany, because don't forget.
So this is the German government that would be lending money under Merkel to?
75% of Germany's exports go to the other European countries.
Right.
And if they're choking them with austerity, they cannot buy German products. So it's to help Germany as well. So we think her legacy, you see these newspaper articles and magazine headlines, gravedigger of Europe. for Chancellor Merkel.
Right.
She's been tremendous by her relative calm, and I think Peter has said it very well. They didn't explode or implode. They basically have had their problems, and some of the recent data, the UK numbers, the Italy numbers for the second quarter have come in surprisingly to the good. They've got issues. Everybody's got issues, and I think you've got to keep that in mind, because when everything looks sunny, then that's already in the market prices, and so this is the time to go picking around.
Now, you had mentioned China, and I know, David, you've got a series of articles coming out, or reports coming out of Morgan Stanley on deleveraging in China. So, you know, China, the fact is, it looks like China is slowing. It's an economy in transition. It's got some big problems. Does that factor into your thinking at all? Is that creating any opportunities as a value investor?
Well, it factors into our thinking in the sense that even though we're bottoms up,
right,
we can't be blind to what's going on in the macro world. And China is such a driver that almost any company you buy that's a global company has a significant portion of its business either directly or indirectly dependent upon China.
Right.
So you can't ignore that. But again, I think it's a matter of, you know, how bad is bad, and is 7.5% growth projection, is that awful? Is that likely? Is that your base case? And I guess, you know, our general base case is that, yes, you know, China is going through some issues. It certainly is trying to become more of a consumer-oriented economy as opposed to the export-driven economy that it's been. And there'll be some bumps in the road. We don't view it as, you know, the catastrophe scenario. So in fact, getting back to some spots where we've found some value, you know, we're not really commodity players trying to buy a specific commodity, but with all the concerns about China, a name that's come onto our radar screen is like a Freeport-McMoRan, which has gone through its own merger and lots of controversy about those transactions and the management of it, but kind of got caught up in this China downdraft, and we looked at it and say, you know, is it beaten up enough where we're being compensated for the risk of a China slowdown? In that case, we thought it was. So yes, it's creating some opportunities, but it has to be an intersection of kind of the big picture, global, with the bottoms-up analysis. That's what we're looking for.
Right. I have to ask you each, because I think you each have an interest in Apple. That's been on your radar screen. So David, what's the current view of Apple?
Well, we like Apple. We think the stock can rise from here. It's down now about 12%-ish from the beginning of this year, Consuelo. Number one, their price-earnings ratio is very low. So you basically, with a $450 price in that neighborhood, that thing could earn a $40 number. So it's selling for 11 times earnings. You take the cash out, and it gets down well below 10 times earnings. Number two, we expect Tim Cook, who's their CEO, as you know, succeeding Steve Jobs, he has said he expects in the second half of this year to get a contract to carry the Apple iPhone on the NTT Docomo, which is their mobile carrier in Japan, and in China Mobile, which has 600-700 million users, none of whom have an Apple right now. So we see that as a second big driver, a catalyst. Thirdly, we expect some new product flow from them. Not only an iWatch or an iTelevision, something like that that's sort of that dazzles everyone, but also the mid-range smartphone is really, the very low end is dominated by Chinese producers and Taiwanese. The high end is Apple and its big Korean rival, okay? The mid area, if Apple, and we expect them to come with a cheaper iPhone in that mid-range, that people want to have that feeling of brand reinforcement. So those reasons, and number five, I left this out. Number five, they're in the midst of the largest corporate repurchase program in stock market history. $50 billion they're buying back of their stock.
Creating enough value
these five
for you
things indicate to us that it's a good place to put some money.
Right.
Yeah, so, I mean, the reality is we own Apple today. We bought it this year.
Right.
We watched it for a long time go straight up. It was always at least in recent memory, a very well-run company, very innovative, but the market was paying for that. The market was paying a premium for that. That's not our business.
Right.
So we watch it, and if we never get our chance, so be it. But as the stock came down and got into the 400s, and the sentiment almost completely changed, where they will never innovate again, the competition was eating their lunch, they were going to eat their own lunch in the sense of having to introduce low-priced products, their margin structure was going to collapse. We thought that became so extreme that the valuation, that's what gets us, right? So between the cash and whether they're going to earn $40 or $45 or $39.50, the stock was trading at a low enough valuation where we thought our downside was very, very limited, and the upside we'll let that take care of itself. We're not saying this thing is trading at 450 and worth 1,000, but you know what? It could be trading at 450 worth 700, and that's a very nice return. So we like it very much as a value investment. But if the stock appreciates, it may be great company, well run. C'est la vie, time to go.
Right. So, activism is another area that Peter, I know you're involved in as well. And one of the companies that's been very much in the news is Dell. And at Mutual Series, you got involved in that Dell battle.
Kerfuffle.
Right.
Yes.
So basically, what's your take on Dell, and why would you choose to get involved in a Dell situation?
Sure. I mean, Dell is a good example of the kind of thing that we'll get involved in. And we've owned Dell stock from time to time over the past, so we're familiar with the company. During this latest chapter in the company's life, again, we look at it on a very specific day-to-day basis. We looked at, obviously, there was the going private proposal, transaction. Other investors, Carl Icahn among others, Southeastern, large shareholders were opposed to it. There was a price on the table. We have to do our work. One, what do we think the company's worth? Two is, what are the dynamics of this deal process? Might there be other competitors or other people coming in, interested parties, et cetera? What are the legal documents say in terms of the ability of somebody else to come in? And we felt in this case that we were able to buy the stock at a level where we felt our downside was limited, in the sense that, one, if the deal didn't happen, we were comfortable that there was a base level, whether it was another recap plan or some other proposal that would protect ourselves. And two is, we felt good enough about the values that we were prepared to buy more stock if the stock came in. And there was a lot of talk about, if the deal doesn't happen, the stock goes back single digits or maybe low double digits. And our judgment would have been that if that had happened, we were prepared to buy more stock. So basically to say, yes, we don't necessarily like to take the hit of a one-day drop, but as long as we're comfortable with the values, we can make money doing it that way. So working through those dynamics, and then we're experienced at sort of being part of that process. So once you're a large shareholder, you in effect invite yourself to the table and have a seat and have discussions with both sides, and that was the case in this situation as well.
And so far, is it working out for the
It
way
is,
you
so far.
think will be good for you as a shareholder?
This will, and we're comfortable that we're going to make money for our shareholders, which is, at the end of the day, that's our objective.
So one investment for a long-term diversified portfolio, David Darst, what should we all own some of?
Well, I think you want to own Apple. We've talked about Apple. Another one that we've mentioned in the past, which is Johnson & Johnson. And they have only 20% of their sales are to emerging markets. So we see the emerging markets as a great growth area for Johnson & Johnson. Their product suite, they've got the drugs, they've got the consumer products, and they have the medical devices, which Peter mentioned earlier is an area that's been under a cloud, but we think they've done a very good job of managing that business. So gross margin expansion, new CEO Alex Gorky came in a year ago, April 2012 he came in, and he's restructured the company and delivering shareholder value. Made a new 52-week high, as you know, but the thing still yields almost 3%, 2.9%. So Johnson & Johnson, but Apple and Johnson & Johnson, put those in your portfolio. That's what we'd say right now.
All right. And what would your choice be?
Both
Peter?
nice companies, by the way. Well, I'd go back to one of the companies I mentioned, is Metro, which again, most people probably haven't heard of who live here. It trades in Europe, but it's got this combination of internal restructuring, new CEO, in a spot globally that people are negative on, this Euro focus that I think they will be able to take advantage of, although the stock had a bit of a run because people have started to believe in the story. Still got a long way to go. So I think that's the kind of name, limited downside, we think, nice upside, a lot of different dynamics, a lot of different things that they control that will make for a very successful investment here.
All right, well, let's see what happens to all of them. Thank you both so much for joining us. Peter Langerman for the first time for Mutual Series.
My pleasure,
Appreciate
thanks.
having you on Wealth Track. And David Darst, it's always a treat to have you back.
Good to be with you. Thank you, Consuelo.
Thank you. At the conclusion of every Wealth Track, we always try to leave you with some suggestions to help you build and protect your wealth over the long term. Well, this week we wanted to share 2 investment book recommendations from our guests for your end of summer reading. David Darst's choice is an investment classic first published in 1935 during the Great Depression era. It is The Battle for Investment Survival, written by then influential money manager, financial writer, and author Gerald Loeb. Darst describes it as a guide to help investors navigate the market's twists and turns, both tactically and emotionally. As Loeb so presciently put it, the most important single factor in shaping security markets is public psychology. Well, how right he was. Peter Langerman recommends the much more recent biography of a fellow value investor who is the Canadian equivalent of Warren Buffett, titled There's Always Something to Do, The Peter Cundill Investment Approach. It is based on Cundill's interviews, speeches, and the daily journals he kept for 45 years, chronicling his successful search for bargains around the world. Well, next week, we're going to explore real estate investing with Third Avenue Real Estate Value Fund's Jason Wolf, who works with legendary investor Marty Whitman, and he and award-winning wealth manager Greg Fisher are going to discuss the opportunities they are finding in global real estate. If you've missed any of our past great investor or financial thought leader guests, you can find them on our website, wealthtrack.com, as well as access exclusive interviews and research in our WealthTrack Extra feature. In the meantime, have a great weekend and make the week ahead a profitable and a productive one.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Luma Sales, investors seeking exceptional opportunities globally. Wintergreen, your home for global value. And Rosalind P. Walter.